Hi, I'm Michael Taila, Director of Fixed Income at City National Rochdale. Welcome to this month's edition of Fixed Income Perspectives. A lot has happened since our last update, so let's begin with a recap of 2024 and share our outlook for the new year. In December, the FOMC reduced the federal funds rate by 25 basis points, lowering the target range to 4.25% to 4.5%. This marked the third rate cut for 2024, totaling a 100 basis point reduction for the year. However, the Fed signaled a more cautious approach for 2025, projecting only 2 additional quarter-point cuts, while emphasizing concerns about reaccelerating inflation. This shift underscores their effort to balance inflation risks and economic growth. In response, the 10-year U.S. Treasury yield rose sharply, ending the year at approximately 4.6%, up 90 basis points in the final months and over 50 basis points higher than where it began the year. The fixed income markets navigated a volatile final quarter as investors digested policy uncertainty surrounding the incoming Trump administration. Despite this, total returns were positive for the second consecutive year. Investment-grade municipal and corporate bond yields remained attractive, with solid credit quality driving consistent demand. Shorter maturities outperformed, with returns between 2% and 4%, while broader market indices delivered roughly 1% returns for the year. High-yield markets excelled in 2024, outperforming investment-grade bonds. Compelling yields, strong corporate fundamentals, and robust demand for risk assets drove significant spread tightening. Emerging market high-yield bonds were a standout, buoyed by strong commodity prices and broader economic growth. Additionally, U.S. and European bank loans outperformed traditional high-yield bonds, benefiting from investor demand for floating-rate assets and higher yields amid reduced distress levels. As we look to 2025, the bond market remains highly reactive to incoming data. The upward momentum in rates from Q4 accelerated in early January. A stronger-than-expected labor report had the 10-year Treasury nearing 4.8% before retreating after a favorable CPI reading. We expect this volatility to persist as investors reassess the Federal Reserve's policy trajectory, inflation trends, and the new administration's fiscal agenda. Our year-end forecast for the federal funds rate remains at 3.75% to 4.25%, broadly aligning with market expectations. We also anticipate that longer-term rates will stay elevated for an extended period. With yields across fixed income markets well above recent lows and credit fundamentals supportive, we continue to believe the asset class presents opportunities for investors to capture attractive cash flows and position for better total returns. Thank you for watching this month's edition of Fixed Income Perspectives. Feel free to reach out if you have any questions.